Ever wonder how a 1031 exchange actually benefits you from a tax perspective? Well, we're going to run through an example right now so that you can see what is the tax impact of doing a 1031 exchange or a like-kind exchange. If this is your first time seeing me, my name is Lauren Ballard. I am the CEO of Hilltown Advisors, an accounting firm located in Atlanta, Georgia, that serves real estate investors and small business owners located in the Southeast US. So we are going to jump right in, and I have my notes on my side screen, so I'm just looking over here just in case you are curious. So what is a 1031 exchange? We'll just cover that really quickly. And I also will link a video that I have, a live that I have, where you can get some more information on that. But a 1031 exchange, also referred to as a like-kind exchange, is based on IRC Internal Revenue Code 1031, which essentially allows you to defer gains on the sale of property, real property, using a 1031 exchange. There are particular stipulations that you have to follow in terms of finding a replacement property and the timeline that has to happen in. But if you do that, you are able to defer the gains that are taken, the gains that occur when you sell a property. So let's go through an example so you can kind of see how this works. So we're going to start with a property value of 1 million. And I'm going to change this marker. I know it's sparkly, but it's throwing me off. So we have a property value of 1 million and the sale price was 1.4. So one of the things that we've talked about previously is something called a cost segregation. So we'll just say cost seg. And what that does is that it carves out a portion of the total sale price or the total purchase price of an asset and moves it from a longer term or a longer useful life to a shorter useful life. And why is that beneficial? So the reason why that's beneficial is that normally real property, if it's commercial, the property is depreciated over 39 years. If it's residential, it's 27 and a half. And when we think about what we hear in regards to real estate, how it is a tax strategy for creating tax-free wealth, one of the things that people are utilizing to take advantage of real estate is depreciation. And so to depreciate an asset of $1 million over 39 years is a really long time. And so with the cost segregation, we are able to carve out, like I said, a portion. Instead of it being 39 years, it could be 5, it could be 7, it could be 15. And why are those numbers significant? Because anything under 20 years, you're able to get something called bonus depreciation, which allows you to take or accelerate the carved out amount into the first year that it's placed in service. So let me clear. Let's just clear this all out. And we'll show what this looks like. Okay, so the purchase price was 1 million. And let's just say we did a cost segregation and we were able to carve out 250K. This 250K, we are able to take as a depreciation expense in year 1. Hopefully, if you are tracking, I hope that you're following me. So if you're following me, make sure that you give some feedback in the comments. I want to make sure that this is super clear for you guys. So it's $1 million. That's what the building was worth. And then we'll say it's commercial, just so we have some context and we know that that's a 39-year asset. So it was originally $1 million. That's what we purchased it for. We did a cost segregation when we bought the property and we carved out $250,000. And this becomes 5, and we'll just say for simplicity, 5 and 7-year property. And so we take that depreciation in year 1. Now, oops. So now we go to sell the property. There's a sale, and the sale is for $1.4 million. The property's basis, or how much the property is worth, prior to depreciation was $750,000. And then we have, we'll say, other assets, and that's $250,000. I know that looks kind of like it's kind of look like zero, so we'll clean that up a little bit so it's clear. There we go. Boom. Okay. So this is the sale that happened in, we're going to say that this happened, go back in my notes. All right, and we held this property for 10 years before selling. So if we were to sell as is, what would happen is that we would have taken, so this property for 39 years would have been depreciated $192,370. That's just for the property. For the other assets, say OA, the depreciation is the $250,000 because we took bonus, which was 100% in the year that we placed it in service. So now with depreciation recapture, this is what happens. So on the $250,000, we have to pay tax at the ordinary tax rate. Depending on the taxpayer, that's going to vary, but we'll say it is 37% for the sake of this example. That is going to give us tax of $92,500. Then on the actual building, the remaining basis, that depreciation that we took of $192,370, that's going to be taxed at 25%, which is what the IRS calls the 1250 recapture rate. It's a special rate. And so that gives us 48,000. We'll just round it and say 48,100. Finally, we have to calculate the tax on the sale, the actual sale, the gain from selling the property. So how we compute that, oops, step 3, we're going to take that 1.4 million and we're going to back out the adjusted basis, which for us is 557,692. How did we get that? That is 1 million minus 10 years depreciation. So our 250,000 and the 192. So that's how we get to the 557,692. which gives us a gain of 892,000. We'll round it and say 308. Now, to calculate what is going to be taxed at capital gains, we'll take that gain and then we'll subtract out the 250 and we'll subtract out the 192 and we get to 450,000. That 450,000 is then taxed at the capital gains tax rate. We'll use 20% here because of the threshold, and that means 90,000. So our total tax, switch colors just so we can see it. We have tax 1 here, tax 2, tax 3. Which gives us a total tax owed of $230,577. So if you sold that property, you had a $400,000 appreciation in value over a 10-year period, and you did not do a 1031 exchange, you would, on your tax return, have to cut the IRS a check for $230,000. So now let's show what happens when we do a 1031 exchange. So with a 1031 exchange, we would only do step, which is calculating the gain. Right? And so then there's no tax that's being paid right now because the tax is deferred. And so we did a 1031 exchange, which means that we bought a replacement property and we did it within the time frame that is required. So you have to find a property within 45 days and you have to close and within selling your property, and you have to close on that same property within 180 days of selling the previous property. So we found that replacement property. We found that replacement property, and that replacement property, we're going to switch colors here. The replacement was 1.6 million. Okay. 1.6 million. So the adjusted basis, because now we're deferring this gain, so we have to consider it. We're not going to get the full basis of 1.6 when we buy this because we have the gain to consider from the last one. So what we would do here is we would take 1.6 million minus the 892,308, and that gives us an adjusted basis, or what you can depreciate, of 707,692. Okay. So what now happens, and we'll say in 5 years, we sell for $2 million. When we sell, we're not going to do a 1031 exchange again, but this is just because we want to see what happens. But it is possible to continue to kind of roll the gains forward in perpetuity to a certain extent. And so we'll talk about that in a second. So now we sold this after 5 years, and this was another commercial property. It has to be of similar kind when you do a like kind exchange. And so we had 5 years of depreciation. That depreciation amount was $90,743. And so our new adjusted basis, because we originally we were at 707 because we picked up that gain from the previous transaction, and then we have an additional 90,000 of depreciation. So our new basis at the time of selling is 616,950. Okay. So if we sold for 2 million, it would be 2 million minus 616K equals a 1,383,050 gain. And so now we have to go back. We didn't do a cost segregation on this one, so we don't have to worry about the bifurcation again. But now we have to go back. And so then we are now picking up the 92.5. This is from the 250,000 that we took from the original sale. Then we have $283.50. This is the depreciation that's subject to the 25%, so the $12.50 depreciation for both properties. And so that amount is going to be $70,763,580. And then once we have these two amounts, we'll go back and do the same step that we did here when we were originally calculating, where we back out what is left that we've already taxed to come up with what is going to be treated as capital gain. So we do the same thing here. We'll take this value, just write it like this, minus 250K minus 283K equals 850,000. This 850,000 will now be taxed at capital gains rate of 20%. And so our tax due on that is 170K. So our total tax bill after buying two properties is 170K plus 92.5K plus 70.8K, which gives us a total tax due at the time of sale of the second property, $3. Now, although that may sound like a lot, well, why would I do that? The reason why you would do that is because you can plan better, right? So if I sell the property now, but I know that I want to immediately get into something, but perhaps I'm retiring. Perhaps I know that this is a good deal that's going to really cash flow, and I want to defer that gain. There's so many reasons. Ultimately, you don't want to pay the tax now. You then just pick that tax up later. And so, like I said, you can, in theory, continue to do 1031 exchanges, and it'll just snowball and continue to accumulate. And it is possible to transfer those assets that you did the 1031 exchanges on, transfer those assets to a succeeding generation and heir, and those gains get essentially wiped out because your heir gets a step up in basis. So whatever the value is, that's what their basis is, as opposed to what it would be sold for. They don't get your basis, they get their own. So I hope that this is helpful. If you want me to do more examples like this, showing you how the math of how these types of things work, please let me know in the comments. I'd be more than happy to do so. And until next time, I'll talk to you later.